I think it was DB was the name of your correspondent. If we get up to that sort of $3,000 level, then there could be some panicking on the short side, as it were, because it's not really the longs who have been buying futures too much. I mean, I think it's shifted a little bit because I see open interest on COMEX has risen to just close to 500,000 contracts. I mean, that's not overbought by any means. And we could go another 100,000 contracts to the 600,000 contract level before you say this market is overbought. So, yeah, I mean, I think there's quite a lot of bear squeeze potential still in there. And 3,000 could be a Rubicon, I think, for quite a lot of the bullion bank traders. Interesting position.
Gold prices continue their upward momentum in 2025, reaching new all-time highs and emerging as one of the best-performing assets in the commodity markets. The gold dollar index trades at a daily high of $2,948, moving steadily toward the $3,000 milestone. With a year-to-date gain of 12.15%, gold has delivered remarkable returns for investors, driven by increasing market tensions and rising demand. This surge is primarily fueled by substantial accumulation from institutional investors, central banks of developing nations, and retail buyers. As economic and geopolitical uncertainties persist, gold's reputation as a safe haven asset strengthens, adding to the buying pressure and further driving up prices. Alasdair Macleod, head of research at Goldmoney, suggests that surpassing the $3,000 mark could trigger panic among short sellers, leading to even higher prices. He also notes that COMEX open interest levels remain far from overbought, indicating room for further growth in gold and silver. Despite ongoing supply deficits, silver, often considered poor man's gold, has lagged in price appreciation. Historically, silver outperforms gold in bull markets, but remains highly volatile, frequently experiencing sharp declines when gold stabilizes. This volatility has led many investors to turn to derivatives to manage risk. In 2024, silver options trading volumes at CME Group hit an all-time high of 18,027 contracts, with weekly options making up over 20% of the total volume. The growing interest in short-term hedging strategies reflects the market's caution towards silver's unpredictable price movements. Some analysts believe large banks and futures traders may be artificially suppressing silver prices. While concrete evidence remains elusive, past cases of price manipulation add to the uncertainty surrounding silver's valuation. This unpredictability can be frustrating for long-term holders, as silver does not always respond to market fundamentals as expected. Macleod suggests that silver's underperformance may be linked to price suppression, potentially by China, but notes that this trend seems to be reversing. If suppression efforts ease, silver could finally catch up to gold, offering significant upside potential. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
The first thing I would say is it's not gold and silver going up so much. I mean, there is an element of that. You can't disentangle it, but it's basically paper currencies going down. This is actually what the central banks see. The reason that central banks are buying gold is that they're actually selling fiat. And, that is a very important point to understand. Ultimately, when everybody understands that it's fiat going down and not prices rising, and we're not just talking gold at this stage, but we're also talking about, groceries and everything else, then the currency is doomed. So we are on the beginning of that curve. In fact, we were on the beginning of that from 1971, when we started in 71 with $35 an ounce, and we're now close to 3,000. But obviously, the way people think, they're not thinking like that. So they're trading it as if it was a stock or, whatever. And I would personally think that 3,000, there could be some consolidation around about that 3,000 level. It's a view. I wouldn't sell on the basis that it's going to, it's going to consolidate and it might tip back and you might be able to do this, that, and the other thing. Why? Because if I sell gold, I'm buying dollars. I don't want to buy dollars. For goodness sake, I want to get the hell out of them. So, that's the emphasis I would put on it. And as far as silver is concerned, I think with the gold-silver ratio close to 90, that to my mind is far, far too high. Silver does have a monetary role. There is absolutely nothing in the price for a monetary role at the moment. But I think when you get the collapse of currencies, silver has got two advantages. Firstly, it's, somebody said it's the poor man's gold. I think that's actually, a sort of a reasonable description for the role of silver in terms of being useful for smaller transactions. I think that's the first thing. The second thing is that if you think that the politicians might try and ban ownership of gold, and politicians are stupid, let's face it, when it comes to economics, they are on a completely different agenda. They will do the most stupid things in economic terms. So I think it would be a bold man who rules that out. But then you ask the question, okay, if they ban ownership of gold, are they likely to do so with silver? And I think the answer is no, because it's not regarded as a monetary metal anymore. So on that basis, there is some justification for going for silver. And my view is that, traditionally, when you get a rise in the price of gold, silver tends to rise about twice as fast. The problem with silver is that when gold stops rising, it falls. Probably not only twice as fast, but it keeps on falling when gold goes nowhere. So that's the sort of problem you've got with silver. But having said that, it's got left way, way behind. And we've had, particularly if you ignore the, sort of selling of ETFs about 5 years ago, silver ETFs, we've had about 7 years of supply deficiency. That's according to the Silver Institute's numbers. And I think it's also been a very managed commodity. I point the finger at China for managing the silver price. And, whether I'm right or wrong, I have no doubt that it has been very, very suppressed. And on that basis, I think the suppression has probably come to an end. And I also think that the bullion banks, they're desperate to try and bring their shorts in. It's interesting, and I think to some extent the sudden premiums that we saw on COMEX, and we saw the price rise something like $200 while open interest fell 75,000 contracts. That's a bear squeeze. And who are the bears? The bears are the establishment. They are being squeezed. And I think they want out of this short position. So that is another factor which is likely to really affect the price. And I think, I think it was DB was the name of your correspondent. If we get up to that sort of $3,000 level, then there could be some panicking on the short side, as it were, because it's not really the longs who have been buying futures too much. I think it's shifted a little bit, because I see open interest on COMEX has risen to just close to 500,000 contracts. That's not overbought by any means. And we could go another 100,000 contracts to the 600,000 contract level before you say this market is overbought. So, I think there's quite a lot of bear squeeze potential still in there. And 3,000 could be a Rubicon, I think, for quite a lot of the bullion bank traders. Interesting position.
The U.S. economy faces mounting recession risks, with J.P. Morgan's chief economist estimating a 40% chance of an economic downturn this year. Concerns over governance and policy decisions, particularly trade tariffs, have heightened uncertainty, leading to the sharpest stock market sell-off in months. A Reuters poll revealed that 95% of economists across North America believe recession risks have risen due to tariffs. In comparison, Goldman Sachs and Morgan Stanley have downgraded their U.S. GDP growth forecasts to 1.7% and 1.5%, respectively. Amid this economic fragility, broader financial instability is becoming more evident. Alasdair Macleod warns that the bursting credit bubble and growing uncertainty around gold's role as a collateral asset could trigger rapid and unpredictable market shifts. As confidence in traditional financial structures weakens, investors increasingly seek safe haven assets. In such uncertain times, staying informed and taking steps to safeguard wealth is more crucial than ever. Let's get back to the interview.
I think what Simon was referring to was that it shouldn't take 8 weeks, which came out in the Financial Times article. It shouldn't take 8 weeks in order to deliver, a couple of 100 tons of gold or whatever. Now, I'm not too sure about that. I think to say that the bank is effectively defaulting, I think is probably wrong. I think it's more a logistical problem. The bank has the gold there. Of that, I'm absolutely certain. I don't know who owns it. It may be twice owned. That could be a problem. For example, if, let us say, you have leased gold and you effectively possess it, you are the owner over the duration of the lease, then unless there's something in the wording of the contract that you have with the Bank of England, i.e. that it must remain stored in the Bank of England, then you can take it out. I don't know whether there is that wording. I would have thought, for goodness sake, if I was running the bullion operation, knowing that in earlier times, gold had been leased and it had disappeared and not returned, I mean, this was the point that Frank Venerosa was making in Lima in 2002. I mean, upwards of 10,000 tons, he reckoned, had probably disappeared from the central bank's vaults. So there's a lot of this double counting. And of course, when you start taking gold out of the Bank of England's vaults, the double counting becomes a bit of a problem. So I think rather than saying that the Bank of England is defaulting, I think what we could be seeing is the beginning of the collapse of the entire system. And I was very interested in an article which I can't remember who did it now, but which sort of talked about leased gold being rehypothecated. So 1 ton of gold becomes 100, as it were. And as you unwind that, it was Jim Rickards. That's who was saying this. But as you unwind that, then obviously there are going to be some very, very serious consequences. And so we could see this as being the beginning of the demise of the paper gold system. Now, if that is the case, then because it is central in terms of collateral, tier one asset, whatever you like to describe it as, then this has ramifications for the whole of the derivative industry. And we're talking about, hundreds of trillions of obligations, which, if you like, rest on this point of the pyramid, with gold being the solid point at the bottom, and the rest of it is all sort of on top, like the Exeter pyramid, if you like.
Right.
So this is something that we do need to watch very carefully, and particularly in conjunction with the bursting of the credit bubble. I mean, the whole thing is all happening at the same time, which means that, if you like, the financial landscape could evolve extremely rapidly, with everybody wondering what the hell's going on and where is my wealth gone? My wealth has disappeared. So no, these are very, very interesting times, and I think it is very, very important for people to follow very careful, credible analysts, who understand this sort of thing. Subscribe to Substacks like yours, and dare I say mine. This is a very difficult time, Danny. I really do think it is, and I think that people are going to get very, very hurt.
Gold's record-breaking surge continues to capture investor attention, reinforcing its position as a premier safe haven asset amid economic and geopolitical uncertainty. As markets grapple with shifting monetary policies and recession concerns, the demand for precious metals remains strong. While gold nears historic price levels, silver's lagging performance raises questions about market dynamics and potential price suppression. Both metals could see further gains if economic instability persists, reshaping investment strategies worldwide. With gold nearing key price milestones, do you see its continued rise as a reflection of economic strength or a warning sign of more profound financial instability? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.